Alrighty, hello and welcome to our year-end tax planning webinar. My name is Haley and it is my honor to be presenting to you today. So let's jump right into it. So, who is Financial Freedom Wealth Management Group? Well, we were founded in 2001. We are a comprehensive wealth management and financial planning firm. Our pursuit is to be the nation's most caring financial advisory team, guiding you, your loved ones, and your legacy towards lasting financial independence and a life of fulfillment. We serve pre and post retirees that want strategic planning to make the most of their money and save on taxes. We help people seeking to grow and protect their wealth. And we also help business owners that need financial services. We have been serving clients for over 24 years now in 46 different states. You can see some of our recognitions there on the right. We have 7 advisors now across 4 different office locations in Oregon, including Newport, Salem, Corvallis, and Eugene. Like I said, my name is Haley Patton. I'm a financial advisor here and tax consultant. I've built my career at the intersection of financial planning and tax strategy. While my background is in accounting, I've discovered a passion for helping individuals build long-term wealth. My expertise in tax allows me to take a detailed, holistic approach to helping clients achieve their goals, and I truly love creating strategies that make sense for each client's unique situation. So let's get into it. Year-end tax planning. I do want to mention if you have any questions as we go through this presentation, please text this number. That's 458-777-4458, and we will respond to you as soon as we can. Alrighty, so right away, 2025 ordinary income tax rates. You'll notice that the rates themselves haven't changed significantly from last year, but the income brackets have been adjusted slightly for inflation, meaning the thresholds for each tax rates are a bit higher. So that can prevent some taxpayers from moving into a higher tax bracket just because of modest income increases. But it's important to keep these brackets in mind when planning income withdrawals or conversions, because even a small timing or income adjustments can make a big difference in the tax that you owe. So as we go through the year, strategies like tax efficient investing, retirement contributions, or Roth conversions can be tailored around these specific rates to help manage and make the most of your tax bracket. Let's talk about the capital gains rates. So these rates apply to profits from selling investments like stocks, mutual funds, or property that's held more than a year. Long-term capital gains rates typically remain lower than ordinary income tax rates, which is one of the key ways to make investing more tax efficient. So depending on your taxable income, you could pay 0%, as you can see, 15% up to 20% on long-term capital gains. And you do want to keep in mind there are some higher income surtaxes potentially applying for those very high income earners. The standard deduction increased a little bit. If you don't know the standard deduction, it's a fixed dollar amount that reduces your income that's actually taxed, lowering your overall tax bill. If you're over 65 or you're blind, you get an additional $1,600 added to your standard deduction. Plus, later we're going to talk about an all-new deduction for taxpayers that are 65 and older. So stay tuned for that. All right, so let's look at some of the year-end opportunities. What can we do to maximize 2025? First thing, of course, as we approach year end, it's a good time to make sure you're taking full advantage of your retirement accounts. Maxing out contributions to your 401k or your 403b or an IRA can make a big difference in the long-term savings. At least ensuring that you are taking advantage of your company's match. And if you're self-employed, this is a reminder to find out if you have the right retirement plan in place for you and your business. If you happen to be in a lower tax bracket this year, it may also be worth considering a Roth conversion, which is when you move money from a traditional retirement account into a Roth IRA. So you'll pay taxes on the amount that you convert, but future growth and withdrawals in retirement can be completely tax-free. For anyone 50 and older, don't forget about catch-up contributions, which give you an extra boost. We'll talk about what those are here in just a moment. So 401k contributions this year, you can contribute up to 23,500. Those that are 50 and older can do an additional 8,000. 60 through 63 can do additional 12,000. And ages 63 and up can do an additional 8,000. For a Roth IRA, if you're under 55, you can contribute 7,000. This applies to regular traditional IRAs as well. You can contribute 7,000. And age 50 and older, you can contribute 8,000. Some other considerations. Harvest losses to offset gains. So tax loss harvesting allows you to sell investments that have lost value in order to offset the gains that you realize on investments that made a profit. This includes investment properties. Maybe you sold an investment property this year. So it's a great way to reduce your tax bill while staying invested. Another point is to review your portfolio positioning before year-end distributions. Reviewing portfolio positioning is important because mutual funds typically pay out capital gains and dividends in December. So buying and selling shares right before those distributions could trigger unexpected taxable income or a missed opportunity to manage taxes more efficiently. So if you have an advisor, talk to them about both of these, and let's move on. The next topic, we're going to talk about that senior bonus deduction. So, like I said, if you're 65 years or older, you get an additional 1,600 plus with the new big beautiful bill, you get an additional 6,000 per person. So, taxpayers over 65 are seeing one of the biggest benefits in decades with this senior bonus deduction. So with this single standard deduction being 15,750, and then the married filing joint being 31,500, plus 1,600 plus 6,000. So if you are married and you and your spouse are both over 65, that means you could have a potential standard deduction of 46,700 that is excluded from taxable income. And then if you're single and over 65, that means you could get a standard deduction of 23,750. There are income limits to this $6,000 additional deduction, so be careful about adding additional income that you choose to, like through a Roth conversion. You want to be aware of those limits when planning. Another thing to keep in mind is with this new bill, they increased the state and local tax deduction, raising the cap from 10,000 to 40,000. This is big for those taxpayers that choose to itemize. In the past years, it hasn't made sense because the cap has been, relatively low at 10,000. But now that it's 40,000 and we are in a high income tax state, Oregon is the 5th highest income tax rate in the United States. So it might make sense for some of you maybe that aren't 65 or older to explore whether itemizing might be worth it for you this year. Another big change with the OBBA bill is they extended and expanded Section 179 expensing and bonus depreciation. So this is big for small businesses, and it makes sense to consider equipment, tech purchases before year end. The return of 100% bonus depreciation means that capital investments, whether machinery, equipment, or other qualifying property, can be deducted in full in the year that they are placed in service. So this can significantly reduce taxable income freeing up capital for reinvestment or other strategic uses. Now, this applies for property that was placed into service after January 19th, 2025. Another opportunity to keep in mind is the 529 plans and educational tax credit. So they were clarified and expanded under this new bill so that families can now use 529 funds for credentialing programs. This means welding, aviation mechanics, and other trade certificates. It also expands the covered expenses, including testing fees if you want to become like a CPA, cost for books, equipment, and other continuing education required to maintain a professional credential. The annual per child distribution for K through 12 expenses also doubled. You can now take 20,000 for K through 12. It's important to keep in mind, though, Oregon still does not recognize K through 12 as qualified education expenses. So if you took an Oregon deduction on those 529 contributions and you use it for K through 12, you might have to pay a little bit of that credit back. So that's just something to keep in mind. All right, let's talk about the annual gift tax exclusion. So this year it remains at 19,000 per person. The new bill, however, ensures that the lifetime estate and gift tax exemption stays at historically high levels. So strategic gifting, if applicable, can reduce your estate taxes later, but for federal purposes, it probably won't be an issue for most Americans since that exemption is so high, and we'll talk about what that is here. So, the US tax code allows individuals to transfer a certain amount of assets during a lifetime and at death without incurring any federal gift or estate taxes. And right now, that amount is just shy of 14 million if you're single and 27.98 million if you're married, meaning you can give that much away without recognizing any gift or estate taxes. Oregon, on the other hand, is at about 1 million per individual, so significantly less. So, in order to minimize estate tax if you're an Oregon resident, uh, gifting in your lifetime can help significantly and hopefully bring you closer or below that $1 million threshold so that your estate won't have to pay those taxes after you pass away. Okay. This is just a reminder of what the federal estate tax rates look like if your estate does happen to be above that 14 million or $27 million threshold. You can see it very quickly goes up to 37% if you are above that threshold. So any income above that exemption amount when you pass away will be taxed at these tax rates. So it's really important to try to keep it below that in your lifetime so that your beneficiaries don't have to pay this tax from your estate once you're gone. On the note of estate taxes, retirement accounts, you want to keep in mind they're always taxable at death to the beneficiaries. Non-retirement accounts, however, and property receives a step up in basis for the beneficiaries at death. That means that when someone dies and leaves you money or property that's not in a retirement account, the value of that stuff gets reset to what it's worth the day that you passed away. That reset is called the step up in basis. And it's a great thing for people who inherit assets because it can reduce or even eliminate the capital gains tax they owe if they were to sell the asset, if they sell the asset later. So, in other words, the higher stepped up value means you're only taxed on the growth that happens after you inherit it, not on all the growth that happened during your original lifetime. And I always want to find a reason to remind you to keep your beneficiaries up to date. End of year is a great time to make sure that your bank accounts, your investment accounts, retirement accounts are all up to date with who you want your beneficiary to be. It also could be a good time to update any power of attorneys you have or get one in place. All right. Let's talk about giving to charity. So you can make contributions up until December 31st for any 2025 tax deductions. Now, looking forward, starting in 2026, the new bill is actually allowing non-itemizers to deduct up to $1,000 in charitable contributions or $2,000 for joint filers. Although this doesn't apply to donor advised funds, it does apply to gifts made directly to charitable organizations. So next year, I highly recommend you don't have to itemize. You can give $1,000 to a charity, get $1,000 deduction. So if you're already doing that anyway, next year is the year to start tracking that and keeping your receipts for your taxes for 2026. Also, consider donor advised funds for larger gifts. If you're unfamiliar, a donor advised fund is a charitable giving account that allows you to make a tax deductible donation, invest the funds, and recommend grants to qualified charities over time. The main benefit is that it lets you take an immediate tax deduction for what you contribute to the donor advised fund while giving you the flexibility to distribute donations to charities over time and potentially grow the funds tax-free in the meantime. And then, of course, consider qualified charitable distributions if you're over age 75 and a half. This is huge if you are also of required minimum distribution age. You can reduce your taxable income by giving money directly from that IRA or that pre-tax account to a charity as a qualified charitable distribution. If you are going to give in the name of the charity, consider naming the charitable institutions as the beneficiary on your retirement accounts. So this goes back to the estate planning. If you're gonna give part of your estate to a charity, consider naming it as a beneficiary on that account specifically, because if you leave a retirement account to a person, they'll usually have to pay tax on that. But if you leave the same account to a charity, the charity doesn't have to pay tax and they'll get the full amount. So there's a couple of benefits there if you are trying to decide which accounts to allocate to who for estate tax purposes. That's just something to keep in mind. Roth IRAs are the exception since they're already tax free. Those are better to leave for the kids and the family or whoever, whatever individual you prefer. And generally, you'll name your family as beneficiary to your trust or your non-retirement accounts because they will receive that step up in basis that we talked about before. Very valuable. Okay, so let's talk some more about qualified charitable distributions. They're still available up to age 70 and a half. You can do up to $100,000 per year. And like I said, they do count towards your RMD requirement, which the new age, it's still 73. So if you're 73 and you have to take money out of your IRA, a qualified charitable distribution is one of the only ways that you can keep that income off of your out of your taxable income. So it lowers both your adjusted gross income and your taxable income, resulting in a lower overall tax liability, and it still satisfies those charitable intents. No itemization required. Alrighty, so let's talk about next steps. Again, if you have any questions, please feel free to text our number 458-777-4458. But I also want to extend an offer to everyone here today and let you know if you'd like to take a closer look at your own financial situation, whether that's planning for retirement or reducing taxes, making sure your investments are aligned with your goals, and we are offering a complimentary initial consultation. It's no cost, no obligation, just a way for you to get personalized guidance based on your situation. So simply text the word freedom to our office phone number and to schedule your financial review. It's a great first step to take towards making your plan. Alrighty, and then I'm just going to stop on these disclosures for a moment. LPL is our broker dealer. They're the largest independent broker dealer in the United States. some more disclosures. And then one more time, here's our phone number. Please reach out. We're so excited to hear from you and see if we can be a partner along this journey with you. And thank you. I want to thank you for being here and listening. And yes, I hope you have a wonderful year end and holiday season. Thank you so much.